On May 15, 1997, Amazon went public at $18 a share. It was an online bookstore operating out of Seattle, run by a man most of Wall Street had never heard of, and it had never turned a profit. If you had invested $1,000 that day and never touched it, never sold a share, never panicked, never moved the money anywhere else, it would be worth approximately $1.2 million today. Here is the thing. Almost nobody actually has that $1.2 million. Not because they didn't buy Amazon. Plenty of people did. They have a fraction of it. Because at some point between 1997 and today, the stock did something that made holding it feel insane. And they sold. Let that land for a second. Amazon's IPO price was $18. After 3 stock splits in 1998 and 1999, the split-adjusted cost basis comes out to a little over $3 per share. By December 1999, 18 months after going public, the stock had risen so fast that a Wall Street analyst predicted it would hit $400 and was mocked by his peers for being too conservative. As of mid-2026, Amazon trades above $220 a share. Adjusted for every split since 1997, the total return from IPO to today is somewhere north of 11,900%. Here is the number that should stop you. That 11,900% return did not arrive in a straight line. It arrived through one of the most violent collapses any major American company has ever experienced while still surviving. Now, here is where it gets interesting. Almost every investor who held through that collapse and came out the other side describes the experience the same way. And it is not a story about conviction. It is a story about almost not making it. But here is the thing. Amazon did not simply have a rough patch. From its December 1999 peak to its low in October 2001, Amazon's stock fell approximately 94%. Not 40%. Not 60, 94. A $10,000 position became roughly $600. Barron's magazine ran a widely read piece during this period stating that Amazon had, in their words, only about 10 months' worth of cash left in the till, a phrase that became a rallying cry for short sellers and skeptics across Wall Street. Stop here for a moment, because this is the part most retellings of Amazon's success skip entirely. This was not a company quietly dipping while continuing to look obviously brilliant. Amazon in 2000 and 2001 looked, by almost every external signal, like it was failing. The dot-com bubble it had been swept up in was collapsing all around it. Pets.com, Webvan, and dozens of other internet retailers Amazon had been casually compared to were going bankrupt in the same 18-month window. eToys, Cosmo. Some of these companies had raised hundreds of millions of dollars and were worth nothing within 2 years. From the outside, there was no obvious reason to believe Amazon was different from any of them. It took until late 2009, a full decade, for Amazon's stock price to climb back to its 1999 high. 10 years of being underwater, watching a peak that some investors had bought near and then waited an entire decade just to break even on, before any of the gains that built the eventual $1.2 million outcome even began. The math is not complicated, but it is relentless. A 94% drawdown does not require a 94% recovery to break even. It requires roughly a 1,600% recovery, because the percentage math of losses and gains is not symmetrical. Losing 94% and then needing a 1,600% gain just to get back to even is the kind of number that, in the moment, makes selling feel like the only sane decision available. Now zoom out entirely. Because Amazon's 94% collapse was extreme, but it was not an isolated event. It was the defining characteristic of almost every company that eventually became a generational winner from that era. Apple fell more than 80% from its mid-1991 high, before bottoming out later in the decade, arriving so close to bankruptcy in 1997 that Microsoft invested $150 million just to keep a primary competitor alive. a decision largely interpreted at the time as a favor, not a vote of confidence. Priceline.com, a company many investors in 2000 considered a more obvious survivor than Amazon, because it had a simpler, easier-to-explain business model, fell more than 99% from its 1999 peak. It eventually became Booking Holdings, one of the most successful travel companies in the world. The investors who held through that 99% drawdown made enormous returns. The vast majority did not hold. Here is the pattern across every one of these companies. Every legendary long-term return that came out of this era required surviving a collapse that, in real time, gave no indication it would ever recover. There was no signal distinguishing Amazon from Pets.com in October 2001. There was no data point that told Apple shareholders in 1997 that the company would eventually become the most valuable corporation on Earth, rather than a cautionary tale. The eventual winners and the eventual bankruptcies looked, in the moment of maximum pain, almost identical. This is not a character flaw. It is a feedback loop built into how the human brain processes loss. Research on loss aversion, first documented by psychologists Daniel Kahneman and Amos Tversky, and confirmed in decades of subsequent behavioral finance research, shows that the emotional pain of losing money registers roughly twice as intensely as the pleasure of gaining the same amount. A 94% portfolio decline does not feel like a number. It feels like a verdict. The brain interprets sustained, severe financial loss the way it interprets physical danger, triggering a stress response that prioritizes immediate relief over long-term reasoning. And then the story changes to protect the decision. The investor who sold during the Amazon crash did not think of it as panic. They told themselves the dot-com era had been a bubble, that Amazon was overvalued, that getting out while anything remained was the responsible choice. Admitting the decision was driven by fear is more painful than believing it was driven by analysis. So the mind quietly rewrites the motive after the fact. DALBAR's long-running quantitative analysis of investor behavior has documented this exact pattern across 30 years of market data. The average equity fund investor consistently earns several percentage points less per year than the funds they are actually invested in. Not because the funds underperform, but because investors buy after periods of strong performance and sell during periods of decline, over and over. Across every market cycle the study has measured. Here is what almost never gets said clearly about Amazon's eventual return. Picking Amazon in 1997 was not the hard part. Plenty of investors picked it. Some of the earliest Amazon shareholders watched their position go from a 30 times return at the 1999 peak down to roughly a 2 times return by 2001, and chose to keep holding anyway, specifically because they were evaluating the business itself rather than the daily stock price. That distinction is the entire lesson. The skill that produced the $1.2 million outcome was never stock selection. It was the ability to sit inside a 94% drawdown, watch the headlines confirm that the decision to hold looked foolish, and not act on the impulse that every instinct was generating. Everyone watching this believes they would have held. The data says otherwise. The data says almost nobody did. Amazon stock has returned approximately 11,900% since its 1997 IPO. The investors who actually captured that return are a much smaller group than the number of people who originally bought the stock, because the price of that return was sitting through a decade where the position was underwater and an 18-month stretch where it lost nearly everything. The question worth sitting with tonight is not whether you can identify the next Amazon. The question is whether, if you found it, you could watch it fall 94% and do nothing.